Hi everyone, and welcome to this new session in which we will review the different transfer pricing methods recommended by the OECD. In order to determine the appropriate method to apply to a transaction, it is essential to assess the situation and accurately characterize the function of each party in the transaction. The purpose of the characterization is to determine what should be tested, meaning what comparables should we look for. So let's start with product flows. If the transaction involves products, a functional analysis is necessary to identify which entity is a routine entity and which entity is the entrepreneur. An entrepreneur company assumes high-value functions and the highest risks. It develops and holds key assets, including intangibles. Its functional profile being more complex, the comparability exercise will itself be irrelevant. No comparable companies would be found. A routine entity, however, will usually have standard functions and limited risks and standard know-how that are generally mastered by competitors. Its functional profile being more standard, it will be possible to identify independent comparable through a search for comparables. The principle is that, as it is more likely to find comparables for the routine entity, it will be our tested party. For product flows, we will try to find comparables for the routine company. It is possible that the functional analysis reveals that both entities have high value added functions, or that neither of them holds lower value functions than the other. In that case, both entities will be characterized as entrepreneurs. Now, if the transaction involves services, the principle is that the tested company is always the service provider. We will have to look for independent companies that provide comparable services. And finally, if the transaction involves an intangible, the tested party is the intangible itself. Now, let's look at the 5 transfer pricing methods recommended by the OECD. There are 2 types of transfer pricing methods: the traditional transactional methods and the profit-based methods. The profit-based methods are to be used only when the traditional methods do not result in a suitable outcome due, for instance, to the lack of comparables or the lack of relevance in the use of the cost-plus or resale price methods. The traditional transactional methods are composed of the comparable and controlled price method, the CAP method, the cost-plus method, and the resale price method. As for the profit-based approach, there are the transactional net margin methods and the profit split methods. Let's start with the comparable and controlled price method, the CAP method. This is the best approach according to the OECD, as it is the most direct and the most reliable approach to determine the arm's length price. Indeed, it consists in using the price settled for a comparable transaction between unrelated entities for an intragroup transaction. This method can be either on internal comparable transactions, meaning transactions between a group member and a third party, or external comparable transactions, meaning transactions between 2 companies that are third parties. In order to apply this method, the compared transactions should be very comparable. If differences of low significance occurred, we would have to make adjustments to correct them. Differences can notably be in the products sold, services provided, volume of sales, or terms and conditions of the transactions. The principal obstacle to tackle to use this method is information availability. Now, let's look at the resale price method. The purpose of this method is to fix the transfer price according to the price to which the product is sold to an independent client, by withdrawing a gross margin in order to cover the operating costs of the tested company. Here, in this example, Company A produces a product and then sells it to its subsidiary A. that in turn sells it to a third party. Here, we are trying to determine to what price does company A sell the product to its subsidiary. If the tested party is a distribution entity, we can use the resale price method. To apply the resale price method, we first look at the final price to which the subsidiary A will sell the product to the third party. In this case, the final price is €100. Let's say that the accurate margin to be achieved by the distribution company following the performance of a benchmarking analysis is 5% of the turnover generated. In that case, the transfer price will be 100 minus 5% of 100, meaning that the subsidiary will pay €95 to the company A for the products it received and accordingly achieved 5% operating margin. The last traditional method is called the cost-plus method. It is kind of the opposite of the resale price method. Unlike the resale price method, the cost-plus method is preferably used when the tested company is a production company. As I'm sure you guessed, this means that here the transfer price will be determined at the production company level based on the cost incurred. The example here is the same as before. A production company, company A, sells products to the subsidiary A, the distribution company. We're still trying to determine the price to which company A sells the products to its subsidiary. As previously said, in order to determine this price, we will place ourselves at the level of the production company. We can see here that the resale price would not work as this method is based on the price to which the company sells the product to a third party. Here, the production company only sells to an affiliated company. The transfer price cannot be based on a resale price. In the cost-plus method, the transfer price is thus based on the costs borne in order to produce the product. The purpose of this method is to add a gross margin to the costs as a guaranteed profit for the production company. In this example, let's say that the arm's length margin the production company should achieve following the performance of a benchmarking study is 7%. Its production costs are €20, meaning that the margin that will be allocated to the production company is 7% of €20, which represents €1.4. That means that company A will sell its product at a price representing its costs plus the margin that we calculated. The transfer price is, in this example, €21.4. Accordingly, the production company will here achieve a 7% operating margin. We have seen every traditional method. Let's now focus on the profit-based methods. I remind you again that the profit-based methods must be used only if the traditional methods do not permit to conclude to a satisfying transfer price. So the first profit-based method is the transactional net margin method. This method determines a targeted net margin to be achieved by the tested company, which consequently will give us a transfer price. The TNM can either determine the net margin on a profit level indicator based on total costs or a profit level indicator based on turnover generated. In this example, the comparable net margin is 3%. The final price is €100 and the distribution costs are €10. The net margin is 3% of €100, meaning that the transfer price will be €100 minus €10 of distribution costs minus €3 of net margin. The transfer price will be €87. Finally, the last method is a profit split method. This method is used when the two co-contracting parties are equally involved in the creation process and accordingly characterized as co-entrepreneurs with intertwined functions performed, assets owned, and risks assumed. In this case, we will have to determine how much each entity brings to the value chain according to the context, the functions held, the assets, and means used and risks borne. Here, we are going to determine, in a first step, the consolidated benefits of the group in order, in a second step, to divide it between the two entities according to their inputs in the value chain. So in this example, let's say that the production company is given a score of 4 out of 10 for its participation in the value chain, whereas the distribution company is given a 6 out of 10. The final price is 100 euros, and Company A and the subsidiary A bear each 10 euros and 30 euro of costs respectively. So the consolidated benefit is 100 minus 10 minus 30 equals 60 euros. We have now 60 euros to divide between Company A and subsidiary A according to their participation in the value chain of the group. We said that the Company A brings 4 out of 10, when subsidiary A brings 6 out of 10. Company A will thus receive 5 out of 10 of 60, and the subsidiary will receive 6 out of 10 of 60. 4 out of 10 of 60 being 24, and 6 out of 10 being 36. Company A will receive 24 euros of the benefits, and the subsidiary will receive 36 euros. Now, let's remember that we are trying to determine what price the subsidiary have to pay Company A for the products it bought. Company A must cover its costs and receive 24 of benefits. So subsidiary A will have to pay Company A the equivalent of its cost plus the benefits allocated, meaning that the transfer price will be 10 euros, the cost borne by Company A plus 24 euros being the benefits equals 34 euros. To sum up, let's see the global picture here and look for each method what the comparability process is focused on and in what case method could be used. For the comparable and controlled price method, we've said that with this method, we directly look for the prices of comparable transactions. The comparability process is held to find an average price for the tested transaction. This method can be used for all transactions involving products, services, but this method is mostly used for financial transactions thanks to the data available regarding worldwide financial markets. Now, for the resale price method, as we've seen with this method, the transfer price is derived from the final price of the product to which we withdraw a gross margin. The comparability process is held to find an average gross margin to remove from the final price. This method is focused on the gross margin, and as we said earlier, this method is preferably used when the entity is a distributing company. The cost plus method also focuses on the gross margin, but in this case, when an average gross margin is found, is added to the costs borne by the tested entity. Unlike with the resale price method, this method is preferably used when the tested entity is a production company or a service provider. Now, for the transactional net margin method, as we said, the purpose of this method is to allocate a net margin to the tested company. This allocation results in a transfer price, but the comparability process focuses on net margin instead of the gross margin. This method is mostly used for tested companies with a very low functional profile. However, these companies can be either distribution companies, manufacturing companies, service providers, etc. Finally, the profit split method focuses on the relevant profit resulting from the group activity. It is mostly used when the two co-contracting entities are so intertwined in the whole activity process that no tested company can be found. They will both be the tested company and receive a piece of the profit according to their participation in the value chain. It can notably be the case in the framework of a co-development of intangible or the co-design of technological products. As detailed in the slide, the gross margin is used for both resale price minus method and cost plus method. Regarding the net margin, it is used for the transactional net margin method that can be either used with a net cost plus profit level indicator or a net operating margin profit level indicator. Here ends this session about the 5 different methods recommended by the OECD to identify a transfer price that respects the arm's length principle.